Rogers TV. Welcome to Smart Money, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host, Mitchell Huynh. I have 2 bachelor degrees from the University of Toronto, one in science and one in commerce, an MBA from the Schulich School of Business specializing in financial management, and several years of financial industry experience. Why are we discussing money? Because money is one of the greatest tools we have, and most of us are not using it properly. Money is a good servant, but a bad master. Instead of working for money, we should be putting money to work for us. Now, we're able to focus on the more important things in life, such as health, hobbies, family, and friends. As Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. That doesn't sound like fun at all. Each week, we will explore different topics and answer your email questions from the differences between RRSPs and TFSAs, planning for retirement, buying your first home, using RESPs to save for your children's education, using insurance to protect yourself and your family, tax-efficient investment strategies, estate planning, and more. This week, we look at the differences between RRSPs and TFSAs and which one of these you should be focusing on to achieve your financial independence and other goals along the way. Before we take a look at what we should do, let's analyze our options. Both RRSPs and TFSAs shelter you from tax as long as the investments are held within the account. With an RRSP, you can deduct the contribution from your income, which earns you a tax refund, but the money becomes fully taxable as income when you take it out. The TFSA, simply put, is the reverse. You don't get a tax break on contributions, but you also don't pay tax on withdrawals either. So if you're deciding between the 2 options, the question boils down to whether you should pay the tax now or later. Let's look at an example to make this clearer. Suppose you receive an annual salary of $60,000. This makes your marginal tax rate around 31% if you live in Ontario. If you have $5,000 to invest in an RRSP, you would receive a tax rebate at the end of the year of about $1,500. If you invested the $5,000 in the TFSA, there would be no tax rebate. The key to the RRSP is to take the tax rebate and invest the $1,500 so that it can grow over time. But remember, withdrawals from the RRSP are taxed as income. Therefore, just because your balance in the RRSP might be $100,000, that is not the amount you will be receiving after taxes. Whereas with the TFSA, what you see is what you get. Now, you must be thinking, how can I possibly know which is better for me? It all comes down to planning, how and when you are going to use the money, and how your retirement is going to look like. You'd probably love to maximize contributions to both RRSPs and TFSAs, but most people can't afford to do that, especially if you have a mortgage and are also trying to save money for your children's education. So what's the best way to save for retirement if you have limited funds? The answer depends on your tax rate. If you're in a higher tax bracket today than when you will need the money, then it's better to use an RRSP. Here's why. Your original RRSP contribution gives you a tax rebate now, and the government takes a smaller percentage of income tax on withdrawal. However, if years from now when you take the money out you're in a higher tax bracket than you are in now, it's better to go with a TFSA. If your tax rates are the same when the money goes in and comes out, then the choices are relatively equivalent. While that idea is simple, putting it into practice is far more difficult. After all, it's impossible to forecast what tax bracket you're going to be in decades from now. But while you can't make precise predictions, most people live on far less income in retirement than they earned in their peak working years. There are many situations where you will do better with the TFSA because it is more flexible. For starters, dipping into a TFSA never has any tax impact, whereas you will be liable to pay an annoyingly large amount of tax if you need to withdraw from your TFSA, from your RSP actually, for an emergency while still working. One of the few times the RRSP account has exceptions to the tax is for first-time homebuyers plan or continuing education. More on this in our later episodes. Furthermore, dipping into the RRSP results in a permanent loss of contribution room, while with TFSA withdrawals, you can put the money back after waiting until the next calendar year. Even more important, you're eventually forced to convert your RRSP into a RIF, which is a Registered Retirement Income Fund, or an annuity by the time you turn 71 and then make mandatory minimum withdrawals. By contrast, TFSAs come with few strings attached when it comes to withdrawals. So if you're looking for flexibility, and especially if you might need the money while still working, the TFSA is a clear winner. An important factor to consider is whether your employer matches your contributions to a workplace retirement savings plan. So if your company tops up your voluntary contributions to a group RRSP, you should make it your priority to contribute enough to get that matching. Free money from employers is always an advantage. The only time you should make the RRSP a priority outside the workplace pension is if you're in a very high tax bracket today and you're going to bring it down significantly in retirement. Make sure you don't spend the refund. This only works if you invest it. Now that we have an idea of what RRSPs and TFSAs are, how should we use them to invest? Think of your RRSP or TFSA account as a house. Inside of that house are rooms, and each room can have different types of investments. These investment products are the tools we will use to achieve financial independence, whether that means retiring early, paying off your mortgage, or putting your children through school without any debt. When talking about money and financial planning, we need to understand inflation. Inflation is your money's greatest enemy. Inflation causes the value of your money to decrease every year. The easiest way to understand this is, let's say for $10 today, you can buy 10 chocolate bars. Next year, for $10, you can only get 9. If you have 10 kids on your street, one of those kids is not getting a candy bar next Halloween. That is going to be one unhappy kid. The message: inflation eats away at your money. If your money isn't growing, you are losing money. And everyone is going to be unhappy, guaranteed. So how do we fight inflation? There are a variety of investment types you can place your money in. We will specifically discuss the differences and benefits between cash, GICs, bonds, mutual funds, ETFs, and stocks. It's easiest to separate them into categories. Cash, GICs, and bonds are low risk, low reward, while stocks, mutual funds, and ETFs are high risk, high reward. Cash is exactly as it sounds. It is keeping your money somewhere that is easily accessible. Whether it's under your mattress or in a savings account at the bank, it's pretty much the same. Is your money going to grow? No. Is it convenient? Yes. End of story. GICs are guaranteed investment certificates. These are similar to cash, except you're required to lock in your money for a specific amount of time. GICs are a safe way to save money because your initial investment is protected. It locks away your money for a period of time, and the banks will compensate you with the low interest rate, which, for the most part, is below inflation. A savings account will generally pay 1.15% interest, while a one-year GIC will pay around 1.4%. If you had $100 to invest, for a quarter more, you're giving the bank permission to do whatever they want with your $100 for a year. What is worse is that when you realize this and you want to break the terms of the GIC, there's a penalty. So for everyone out there that likes GICs, please come by the studio with your money. I have a stack of quarters for you. Quarters for everyone. Say goodbye to your money for a year. Is your money growing? Hardly. Is it convenient? Absolutely not. Your money is here in my pocket, and you can't touch it for a year. It's like money jail. It's locked away. Why are you punishing your money? GICs generally have more drawbacks than benefits. It would be much more beneficial and flexible to keep your money in a high-interest savings account where you can access and use it at any time, rather than locking your money up in a GIC. Bonds are similar to GICs in that they offer a fixed rate of return for a set period of time with principal protection. These generally have a much higher rate of interest than GICs. Although bonds guarantee your principal, your money is still at risk of the bond issuer going bankrupt and defaulting on their loan payments. A bond is essentially a loan contract between you and the bond issuer. Bond issuers can range from countries to companies. Bonds are great for regular interest payments. However, interest income is fully taxable, which decreases their relative return. Moving on to higher risk, higher reward investment types. Imagine these to be the James Bonds of the investment world. Exciting and sometimes scary, but generally have a positive result in the end. Mutual funds are a portfolio of bonds, stocks, or other investable assets that are selected and managed by professionals on behalf of many investors, like yourselves. These fund managers pick and choose the best assets to include in their fund according to the fund mandates or goals. These funds are usually managed in a tax-efficient manner. However, the drawback of having professional management is the management expense ratio, also known as the MER. Depending on how actively managed the fund is, the higher the MER. This is a service you are paying for, and these expense fees will reduce your gains on the funds. Bottom line, is your money going to grow? Yes. Is it convenient? Yes. Do I need to lose sleep at night? No. These funds are professionally managed by the best in the business. ETFs, or exchange-traded funds, track an index, a commodity, bonds, or basket of assets like an index fund. Unlike mutual funds, an ETF trades like a common stock on a stock exchange. Since ETFs follow an entire index, they typically have lower fees than mutual funds as they are not actively managed. Bottom line, is your money going to grow? Yes. Is it convenient? Yes. Do I need to manage my ETFs myself? Unfortunately, yes. Since the ETFs only follow whatever market it's in, if the market is underperforming, the ETF will as well. This is one of the drawbacks of a lack of a professionally managed portfolio. Equity investments usually refer to buying and holding of shares of a stock of a particular company in hopes of gaining from dividends and stock and capital gains from stock increases. These investments are great for the savvy investor, since you can pick and choose the exact company you want to invest in. This is great if you have a favorite company and you'd like to own a piece of it. But unless you have extensive investment experience, putting together your own stock portfolio would be like betting on numbers on a roulette table and hoping that one of them hits. Bottom line, unless you know what you are doing, it is probably best to leave this to the professionals. That, in a nutshell, are the investment products that are available to the average investor. So which one of these is the best place to put your money? The answer is, depends on your risk tolerance and timeline, which we will discuss in future episodes. However, any questions of where you should be investing your money can be answered by an index chart. This graph tracks the performance of $100 invested in the different asset classes from 1926 all the way to 2011, with the different lines representing the different asset classes. That $100 invested in the market, which is stocks, mutual funds, and ETFs, turned into just over $248,000. $248,000. While that same amount invested in bonds grew to a measly $5,900. Cash and GICs? Let's not waste our time speaking about these. Time is money, and there is no money to be found there. People often ask me, but what about the financial crisis of 2008? We might lose our money. My answer, not if you invest wisely and for the long term. If we take a look at 2008, when the huge subprime mortgage crisis happened, and a lot of the big banks in the US were being bailed out, we'll notice a dip here in the blue stocks line. However, by 2011, we observed that the market has recovered most of its losses and is on track to continue to make gains year over year. This leads us to question, why are so few investors in the market, if we know that over the long term, markets have always gone up significantly? $248,000 or $5,900. I know where I'm putting my money, in the market. The key to investing is having a long enough time horizon to ride out any potential market downturns and take advantage of the growth as the economy expands. However, if you want to get fancy, that's where timing the market comes into play, where we make educated predictions on when the market will start slowing down and we sell our investments to take profits and avoid losses. And then when the market starts heating up again, we buy in to ride it back up and then some. We'll speak more about these in our future episodes. Next episode, we look at the basics of financial planning. How do you achieve your financial independence and other goals along the way? And how can we crash-proof our plan once it's made? Most people think that financial planning is putting aside a couple $100 a month into their RRSPs and TFSAs. Although it's good to put aside money, this in itself is not a plan. A plan involves specific goals and milestones, quite similar to a business plan or roadmap. You need to know what you want and save towards that goal. Want to retire in 10 years? Great. How much money do you need to retire comfortably? How much money do you need to invest to get there? How is this going to affect your current lifestyle? These are all questions we need to answer. So tune in next episode as we explore the world of financial planning. We'll go through a sample financial plan to demonstrate the effectiveness of a real plan and what measures we can take to ensure the plan becomes reality. I look forward to all of your email questions. Have a topic or question you'd like answered on the show? Contact me anytime at mitch@smartmoney.ca. That's mitch@smrtmoney.ca. We will be back with more Smart Money after the break.